Hello, today is Thursday, May 14th. I'm Simon Harry, bringing you a truly independent perspective. Today, I had the good fortune of sitting with Paul MacDonald, who is the CIO of Harvest ETFs. He was sharing with me the Harvest investment discipline, how they generate yield for clients, and also thoughts on the markets today. I hope that you find it as interesting as I do. And if you want to find more content, you can go to my website at www.simonharry.com. All right. So basically, what I'm doing is I've got a series of videos that have to do with interviewing portfolio managers, also just about around investing and how do you invest, how do you choose an advisor, how do you choose a firm to work with. There's a number of different categories that I'm starting to do segments on. And it's called Independent Perspectives. So what I'd like to do is just have a conversation style interview where we talk about whatever kind of comes to mind, and your thoughts on just about anything are welcomed. But just to intro you, and you're the Chief Investment Officer and Portfolio Manager for Harvest ETFs. And you've been in the investment industry for about 25 years. So we both started around the same time. And this is not your first rodeo when it comes to seeing a market meltdown. And if we could just start with your thoughts on where you see the markets right now and how this is the same as other times, how it's different than other times. If you have any perspective, that would be great to hear.
When we're expecting a market correction, everybody says, "Oh, we're looking for 5% or 10%," and then they get the first 2%. And it's like, oh, I don't really like this actually. And yes, we've seen these types of events before, but I liken it to touching a light socket. You know it's going to give you a shock, but lo and behold, once you touch it, you still get shocked. And as unpleasant as this one is, and it is somewhat different. It's every recession is similar but different, and obviously this has changed our lives. The COVID has, and so. We do believe, though, that this will pass. It's not the first time we've had a market like this. When that happens and the duration of this is still unknown, as it always is. But what we do know is that there has been a huge amount of stimulus that's been put into the market. It's unprecedented. The velocity, the swiftness that it has hit, that will add to the durability once we do get through the crux of the COVID crisis.
There's so much to get into there, but before we do, can you just tell us a bit about your role at Harvest? You're the Chief Investment Officer and Portfolio Manager for Harvest. What do you do and what are your responsibilities?
So I oversee our team. I work with each one of our portfolio managers who have between 10 and 20 years of experience as well. And I also co-cover sectors. So I cover specifically healthcare as a primary coverage, and so we work together in an open team. Each one of us has very specific duties associated with the sectors in which we manage. Our funds tend to follow very similar processes, though. We tend to be very value-based, if you will, and we follow very structured universes. So one of the things, as I'm sure you've seen with portfolio managers over the years, they come out with a large cap Canadian equity fund, and 5 years later you look underneath the hood and it's a mid cap energy fund. And so we've got very structured processes, and as far as minimum market capitalizations where we invest, but also how we get down to our portfolios is very structured. The way I can give an example perhaps is with healthcare, again, my primary coverage, but this transcends whether it's healthcare tech or technology fund, our leading brand funds. We started with a very large universe of companies, quite often, over 1,000 companies. And from there, we implement very basic minimum market capitalizations of 10 billion, North American listed. We do have covered calls, so we have to have options available on our securities, which we can talk about in a moment. And so all that really does is narrows down our universes down to a very manageable 60 to 80 companies from which we pick 20. And so my role in that is, of course, with my primary sector, but also working with our portfolio managers on ensuring that we have proper diversification within each one of those funds, and working with them on our option strategies as well.
So basically what you're talking about is having a very disciplined approach where you're looking at companies that are the leaders in their fields, having a broadly diversified portfolio, and then just focusing in on 20 names out of a universe that of 80 that comes from a universe of thousands, really.
That's a great way to put it. Just very disciplined, and really that's what we want to focus in on. Is we want to own, whether it's in a specific sector or a specific area that has longer term secular growth. We just want to own the best quality businesses in those areas.
When you are looking at a company or you're looking at an investment, are you a top down or a bottom up and investor? And can you just talk a bit about the difference between those two styles?
So I guess we're a combination of both. Top down being you would look at the macro world. Where do you see the macro world? Are we in a growth? Are we looking more for value? And then versus a bottom up perhaps would be just straight up just looking for a very specific metric within a stock, if you will. And so what we like to do is we do take a view on the world, but we recognize we're not so smart that we can necessarily predict every event. So diversity is key when we're building out those portfolios. We have very specific metrics that we have to meet. So inside, and a great example would be in our brand leaders fund, which is 20 mega cap, if you will, US listed companies really that are amongst the best known global brands. When we build that out from our universe of, call it 80 names that we've narrowed it down to, our portfolios have to meet very specific price to earnings valuation, dividend yield metrics that are superior to our universe. And again, this is a way for us to really ensure that discipline of not chasing a specific company or a company that perhaps has a very high growth expectations. And it also ensures that we have diversity within each one of the subsectors that we invest in.
When you're looking at your universe of companies, you've got 20 names. One of the focuses, I understand, of the Brand Leaders Fund is having a very high yield for investors. So when somebody invests in the Harvest Brand Leaders Fund, they can expect to have a high yield. When you're looking at a company, of course, the dividend that is being paid would probably be something that you'd look at. But you also use a covered call writing strategy. Can you talk a bit about how you're using that strategy to manage volatility and create more yield?
Absolutely. And so the one thing I love about the brand leaders is when we speak with advisors, the messaging is very straightforward. Here's the 20 companies, and when you look at the companies, these are the types of companies we want to own now. And I said that in this market, I said it in last year's market. It really is where you want to be invested. It is leading businesses that have economic moats around their businesses, diversified global exposure. And it really is, I would say, the who's who of dividend elite, if you will. So, and they really are leaders within each one of their businesses. And so that's kind of the initial, it really is firstly about the underlying investments. The second part is on the income and the covered call. So just to reinforce a little bit on how we pick those 20 stocks, we do have to satisfy basic metrics like price to earnings, dividend yield. We're looking at numerous other types of metrics from free cash flow, balance sheet items, and in particular, in the current environment, those balance sheet items, perhaps in various markets, there's a little bit more focus in on growth, and other times there's more times to be a little bit more focused on balance sheet. So right now we tend to have a little bit more focus on balance sheet. So again, 20 equally weighted companies of what we think is the who's who of where you want to be invested right now. So the part two to our strategy is what we call a covered call. And so the average dividend yield within the portfolio is about 2.25% to 2.5%. And so we pay out just north of 7% distribution. And our funds really that we manage are between 7 and call it 10%, although we do have a couple that are a little bit higher and a couple that are a little bit lower. And so how we go from that 2.25 to north of 7 is predominantly through that covered call strategy. And so what covered calls would do, and I'll give a very simple numerical example. If I have a stock at $100, somebody may want to buy a call option on the right to buy the stock at $100. They may pay $2.50 for that. If the stock goes up, they will get they'll be able to buy the stock at $100. From our perspective, we get to keep the $200. We sell them that call option. We get to keep the $2.50. And so that's a bird in the hand income that's earned for the portfolio for that particular period. Typically, it's 1 month that we do our options, and we do that each month. And so if the stock goes up to $110, we only participate on the portion that we aren't written on. So we still have our $2.50, and we only participate on what we're not written on. So what that would mean is we're only allowed to write 33%. So that means stock goes from 100 to 110. We have 67% of that upside. Stock goes down to 90. We still have that $2.50 on the portion that we've written. And so it's a strategy really that enhances income. Now, for us, that's the primary objective, is how much do we have to write on each one of our portfolios in order to generate the specified fixed income that we pay each month. And so in this type of environment where the volatility is high, it's been really advantageous for people to know that that income is consistently coming.
When you do write calls, one of the things that you mentioned is that you have a cap on the amount of calls that you can write on your portfolio. Is there a minimum of the calls that you would write? Is there a time that you would take the covered calls off the table and perhaps even buy back the calls that you've written?
Absolutely. There's two environments, and we're actually in one right now. Our first objective is to earn the income. So any particular month, we have to write a different amount. Maybe it's 20% on the portfolio, maybe it's 25%. How we go about that 20 to 25% varies each month on numerous factors, but the primary one is volatility. So options get priced off volatility. And so some months we might be, like I mentioned, 15, 20%, other months are 20 to 25%. Sometimes we'll have one contract on a particular name and it will only be for, call it 20%. Other months we might have a stock that's at $75. Our modeling would indicate that we can, write a little bit at 75, a little bit at 80, and a little bit at 85. So we're capturing a little bit more of the upside. And that's exactly what happened from March to April, where we really kind of a little bit more systematic, versus coming into the March, from February to March, we were very underweighted on our write levels. So meaning kind of we're maybe 10 to 15% written, but across 40 to 50 different contracts. And what that would mean is like I just said, we have one written at 75, one at 85. And it was quite phenomenal to see the amount of premiums that we were getting. It was near the highest I have ever seen in my career, because the volatility was so high. So it's an active strategy in and around how we earn the income. And we look at all kinds of modeling each month that says, this is what we should be getting paid for this particular option. But when I kind of package that all back up, the very front end of that analytics each month is how much do I need to write to generate the net after withholding tax, after fee income for the distribution. So for us, it's how we go about it, but we still want to earn that income. Sometimes, as you mentioned too, we write an option at 100, stock goes down to 92. The option then becomes worthless. Or effectively worthless. We will buy them back intra-period, and I don't want to overcomplicate it. There's some. It's again, I'll kind of bring it back to the start, which is it is a way to enhance income. It does reduce the volatility a little bit because you are getting that premium each month.
This is one of the things about the strategy. As an investment advisor and somebody who is also options licensed, and I do a little bit of options business on my own here. It's the sort of thing that can add tremendous value, but it's hard for people to really kind of grasp what it is this strategy is at the end of the day, even though it's super simple. And it's even harder to execute. And when you're executing on an institutional scale, it's a little bit easier to perhaps find counterparties. So I would actually be curious, is it easier to find counterparties is number one, because I'm on a retail level, you're on an institutional level. The other thing is that we're coming off of a period of extremely high volatility, which then lends to higher options premiums, which lends to more profitability when you're writing the calls. What are your perspectives on volatility where we are right now as well? So this is two questions, one on volatility and one on your experience doing it on an institutional level.
Great way to start this is from a retail perspective for clients. I always tell people, look, there's nothing for free. And so when you're looking at a covered call strategy, as I mentioned, stock goes from 100 to 110, there is a trade-off. And so if people just want to be exposed to the market and don't have a need for the income, then the covered call is probably not the strategy for them. It really is, you want to have that enhanced income from the covered calls. And the reason for that is you do forego in an up market, you will forego some of the upside on the underlying stocks. Like I mentioned before, we're always maximum 33% written. So you'll still have upside in ours, but you'll get a higher income, and you really want to have that higher income. So from an institutional perspective, and from our counterparties, I believe we have about a dozen different parties that we interact and trade options with. Most of our options are on large and mega cap US, although we do some in Europe, which adds a little bit of a difference versus the North American. In our brand fund, though, everything is US listed. We typically do have counterparties that we'll trade baskets with. So we will put up a basket and look for best quotes on the basket. Also, from a cost perspective, it's a penny a contract that we pay. So it's very inexpensive to do it from an institutional, and to be doing baskets of hundreds of contracts across multiple positions. It really is, you do get that economies of scale. To your question on volatility, when I said that we were getting paid the most I've ever seen, it's because there's two types of volatility. There's the one that you can look back at, and most people look and say, oh, look how volatile the market has been. And then there's one that's called implied volatility. And so that's what the market's expecting to happen. And so I don't know what's going to happen, but I do know that the market is expecting it to be more volatile when I see implied volatility. So what causes that? So let's take COVID out of the equation for a moment. Typically, we would see implied volatility levels go up in and around catalysts. So what typically moves stocks? Things like earnings would be a catalyst. Industry-focused conferences. So actually, there's one coming up, American Society of Clinical Oncology, where there's a lot of data that comes out that can move stocks. So even though the stocks might be flat today, when I look out to 30 days from now, the options are highly priced because the market is expecting the stocks to move around these catalysts. So that's where we see what we call the implied volatility. When I look back, and we charted this out, and if you want a copy of what it looks like, it really is phenomenal that we have not seen, I charted back 25 years, we have not seen volatility on numerous positions like we saw, even through the 08 crisis that we saw going back in through March. And when, if somebody's a mathematician, we had 9 standard deviations away from the 3-year average. These are extreme volatility levels that we were in. Now, where we're at today is a different story, because volatility has come down quite significantly. We're still well above 3-year averages, but we were in a potential crisis zone, was what the volatility was telling us. And I actually think that the amount of stimulus that came into the marketplace, unbeknownst to a lot of us, the credit markets were becoming very, very strained. And so there was a huge amount of stimulus that went into to effectively ensure there wasn't a freezing in those credit markets. And that's why I think volatility and implied volatility was so high. And the stimulus also worked because credit started flowing again. And so with that, our volatility levels have come down a little bit. We still think we're going to have volatility, though, coming in through at least the second quarter. We've gone through earnings season with the S&P 500, almost done now. And effectively, the market has said, okay, everybody gets a pass for the most part. And so the language coming from companies, and Facebook was a great example. I was talking to our portfolio manager about how basically advertising revenue stopped in March. But then the communication was that we started to see a pickup through late April. And so the question will now come in through the June quarterly earnings coming out in July and into August. What is the language around corporations? Are they starting to see a pickup? Are things starting to turn around? And so because of that language, we would expect volatility to remain high. I know that was the long answer that was intended to be a short answer.
Not at all. Not at all. That was fabulous, because it really opens up the conversation just a touch into some of the things that we as advisors speak about and that we as money managers speak about, which is that there are so many more things to look at than the market. So when you're watching business news, you'll have a tendency to say, oh, well, the Dow is here, the Dow is there, the S&P is here, the S&P is there. Meanwhile, we're looking at implied volatility inside of the options market, inside of the treasury markets, and that tells us a lot about what to expect going forward. There's a lot of data that you can actually look at, and the options market is and implied volatility is one that's really important. Is there anything that you're reading from the implied volatility in the options market right now, as far as what to expect in the short and medium term?
I think shorter term that I wouldn't be surprised to see we've compressed, the volatility's compressed from the lows in the market when, like I said, things were almost freezing within the credit markets. I wouldn't be surprised that we see volatility start to pick up in through as we look out sort of 2 to 3 months from now. Shorter term, it really has subsided here a little bit, and then it becomes, like I said, once you look out over the next 2 to 3 months, and I think you bring up a great point too, just on there's so many things to look at, and I think one of the things that has been challenging for investment advisors and money managers is, what is the real data? When we look at earnings, the earnings were most companies, or a lot of companies, eliminated giving guidance for 2020 because there still remains tremendous uncertainty. The GDP data, the employment statistics, what's the duration of these economic data before we start to see a resumption? And so in a traditional market, we'd be able to forecast these things. And so one of the things that we've been spending a fair amount of time on is, where are the green shoots? Are there any green shoots? Is there anything that is indicative that the worst is behind us? So like many others, we chart out every state, all the different COVID metrics that you could possibly think of We also have data coming out of a third party out of China that measures things like traffic congestion during peak hours to give an indication of how are people going back to work? What are the smog ratings over major cities? Is industrial production picking up? And so, I guess on the positive side, we are seeing some green shoots. We're still in the midst of, we don't know what the duration of the shutdown is going to be. One of the other areas that we'd like to look at is investor sentiment. And, I know what you and I spoke in the past about, are we traders? And absolutely we're not. We're active around our option strategy. We want to own really good businesses. And, the Dow is up or down 1 or 2% today, or the S&P. We're not looking at that. We want businesses that are going to survive through this tough time and are going to flourish when times get better. And so one of the key data points that I've seen recently is investor sentiment. And it is phenomenal how bearish people are. And typically when we look back, that has been, again, one of these sort of atypical indicators that you would look at that would be indicative that, okay, people have just become too pessimistic. And so when I look at, the amount of stimulus that's come into the market, the bearishness of in investors at a time when cash levels are rising, to me, these are all, when we put these into kind of a washing machine, we want to be invested here. And it's very difficult to do so because there still remains tremendous uncertainty.
And this is one of the most interesting things, is that generally speaking, you want to be investing when nobody else wants to be investing is kind of one of the contrarian ways of trying to figure out when to position money. It's also the hardest time to be doing it. I know I saw on a presentation that you had earlier, one of the slides about investor sentiment. I might try to put that up here just to kind of demonstrate what you're talking about there, because I think it's a very, very important point. One of the things that it's one of these guilty things that I have where I really do not like to mention company names, because when somebody hears a name and they say, oh, well, hey, Simon said this is a good thing to buy, or they see something on BNN, oh, this is a good thing to buy. This might end up being something that is good in the short term, but not necessarily in the long term. And when people depend on their stock tips, they might have a good idea at the moment, but the story can change and they're not really monitoring it. And so if they're not in a relationship with the person that's giving the advice, or then they might end up in a situation where they're holding something and the story changes and then it becomes a bad idea where it was a good idea for a moment. That said, could you discuss about what positions, perhaps some of the positions you're holding, and if there's any bright spots that you can see?
The first area that I would say is that has been performing well, has defensive characteristics, is healthcare, and so we do have the largest healthcare ETF in Canada, and so there's been numerous positives despite everything going on in the marketplace that have been happening underneath the surface. Having Biden coming in as the presidential nominee for the Democrats, that's been positive versus a very low risk of a Bernie Sanders. You've also had sentiment really shift towards the group, as the politicians have typically pointed to the pharmaceutical companies, with vengeance, versus now they're pointing to them as potential cures, or potentially ending the pandemic. And the other one is visibility. And so that's an area of the market where we still have a visibility into their cash flows and earnings. So healthcare is a superior good, meaning in an up and down market, most of us anyway would spend money on our medications as opposed to more discretionary items. So I would say healthcare would be one area that definitely has some positive attributes. The other area that I'll mention a couple of names in a moment, the other area that we talked about earlier is technology. And so this event that we're, going through, there is structural positives for that sector coming into 2020 already. Technology was a leadership sector in most of the last cycle, and so I believe that a lot of those trends that were medium to longer term, the digitization of the consumer, even working from home, the cloud data, big data, all of those trends that were in place have been brought forward. And so when we take those two sort of top down, as you were suggesting before, and we look at the bottom up, what are some of the companies that are really well positioned to benefit in that environment? I think in our brand leaders, we own Johnson & Johnson. I don't want to oversimplify it. They are a dominant leader, diversified across healthcare, and it's the only healthcare position we have in that portfolio of 20 that's equally weighted. Another name that we own in there is Microsoft, and they just have so many parts of their business that really benefit from what's happening in the current environment. And so again, a leader that we would expect to dominate coming through. And in another area that perhaps is a little bit less, not so much direct into those themes, the CEO of Nike said on their conference call, this is when, and I'll paraphrase without having the quote in front of me, this is when good brands get better. And I see that not only with Nike, but also with McDonald's. When we think about when people move back into normal days and the recovery starts, McDonald's has continued to operate through this whole crisis. And in fact, in places like Australia, you were able to go through and get milk and eggs from McDonald's. Their infrastructure and supply chain enabled them to do that. To me, that just further entrenches their brand loyalty towards that company. So perhaps a little bit more of an impact than, say, Microsoft or Johnson & Johnson in the current environment, but are positioning themselves to really benefit as we get through this and resume to what is likely a new normal.
One of the things that makes brands brand leaders is that they adapt to whatever the environment is, as you're saying. Absolutely. One of the interesting things is when you start talking about mega cap companies and a lot of the companies that are in your portfolios, your Microsoft, Johnson & Johnson, McDonald's, there's a number of others. The vast majority are U.S. companies. And there's again, I love my two-part questions, which is one of the things is that the thing that I like as an advisor is that you guys have a number of different versions of your fund. You have a US dollar version, you have a Canadian dollar unhedged and a Canadian dollar hedged version. Where do you see the where do you see the US currency versus the Canadian currency?
Great question, because it's again, one of the areas that we look at on a day-to-day basis is we look at the global currency markets. And again, one of the indicators that we're currently following and have followed for a number of years is the Australian US dollar cross, and of course the Australian Canadian dollar cross. And I'll come back to the US CAD in a moment. And so one of the reasons we look at that is because you can really see, China is onto Australia. And so currency markets do tend to be quite efficient, and in particular in very short periods. Meaning that they will be a leading indicator perhaps of resumption in various economic activity or deceleration in economic activity. So we like to follow those for very short term. Again, not one data point tells a story. With the US Canadian dollar, it's over the medium term. I really do think the US has a more robust backdrop, if you will. Just given the nature of our mega cap companies. One thing I know over the medium term, though, is that I can't predict currencies. And so I bring it back to, does somebody want to have that currency exposure? Do they mind having fluctuations? If they perhaps have a strong view that the Canadian dollar is going to depreciate, then they may go to an unhedged version of our funds, so dot B as we call them, We do have our hedged version, and part of that too is that I don't want to ever have to come and explain to somebody, yes, I know that the market's up 30%, but you're flat, and so really the hedged version does that. It takes that currency out, and then and I want to bring up taxes as well in a moment. And then on the US dollar version, it really is a way for investors to get US dollar exposure in US dollars, pays the distribution in US dollars, and when they sell it, comes out in US dollars. Really, if people have a need for US dollars, that's why I would suggest somebody look at that particular class. It's all part of the same fund. We don't manage differently. It's all pro rata for each one of those based on how much money is in each one of the classes. And lastly, I think there's two other points that I know are worthwhile. Owning a US dollar version of a fund in Canada, there are some tax benefits potentially, in which you don't have to fill out certain types of tax forms for the US. I think T1135A is the form, so it's considered Canadian property. For some, that matters. And then part two is the taxation of options, which we didn't touch on before. So the taxation, it is very tax efficient. Options are taxed as capital gains. So if we do have capital losses, we can even add to that efficiency. But there is some tax efficiency to our distributions.
It's interesting because one of the things that I'm working on right now is, how to choose an investment advisor is a post that I might as well just, advertise it here right now. But one of the things is that if you want to keep track of all of the different reasons why to do things, it's great if you have an interest in that. But if you don't, this is one of the reasons why you do need to have an advisor, because there's so many different data points, there's so many different things to look at in the markets, but then even things like tax efficiency that you mentioned, it's something that I did not mention, but it is extremely important. If you're getting an 8% dividend yield or an 8% yield on your investment, and that yield is made up of things like dividends and capital gains and return of capital rather than interest, that can make a substantial difference to you in a non-registered portfolio. And thank you very much for bringing that up. We're getting on in this interview, and I'd love to sit and talk to you for hours and hours, of course. But what perspective would you give to investors right now in this time of uncertainty?
I'll come back to your comment on a financial advisor, Simon, because I actually think now more than ever, it's extraordinarily important to have somebody that is engaged, somebody that can make sure that you're sticking with a plan and that's suitable for your investment needs, with an understanding of some of the risk return characteristics. I think, to me, that's very important in the current environment. And so I think from an overall positioning standpoint, now I think is really also a time you have to focus in on quality. We really don't know the duration of this. We know it will pass. We want to stay invested, but really focus in on quality and make sure that you're sticking with your advisor's plan.
That's wonderful, Paul. I really, really appreciate you taking some time with me today. It means a lot to have access to somebody that's actually hands-on managing money on an institutional level. Thank you for coming out. And anytime you want to come with a new independent perspective, we're happy to have you.
That's great. Thanks again for having me, Simon.